Hi, thank you for joining us for our quarterly market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Syverson Strege. The positive momentum of the stock market from the fourth quarter has carried over into the new year. We are recording this about a week before the end of the first quarter, and so far, the market, as represented by the S&P 500 index, is up about 4.5% year to date. The year started with some big headline news in January regarding shares of video game retailer GameStop. After a group of investors came together on social media in an effort to push the stock price higher, the company went from trading around $20 per share to nearly $350 per share. The investors were reportedly trying to make money while at the same time trying to hurt large hedge funds that were shorting the stock, which is trying to profit from the price of the company falling. As all investors tried to understand what was going on, the stock market fell close to 3% for its biggest one-day drop in several months dating back to last October. Luckily, the market calmed down and resumed its upward trajectory. However, the stock market was spooked again in the middle of February by rapidly rising interest rates. The 10-year treasury bond yield has risen quickly from about 0.9% at the end of last year to about 1.7% currently. The main reasons appear to be increased economic growth and inflation expectations. Inflation expectations over the next 5 years have risen to about 2.5% on an annual basis, for the first time since 2008, according to Bloomberg. The Federal Reserve does not appear to be too concerned at the moment. They had previously announced they would not increase rates until 2023 at the earliest. They have also indicated they will let inflation run hot above their 2% long-term target for an extended period of time before taking action. It was predictable that interest rates would be rising after they fell to record lows during the pandemic. However, investors seem surprised at how quickly they rose. The rising interest rates are not good for bonds, at least in the short term, because they cause bond prices to fall. The Bloomberg Barclays U.S. Aggregate Bond Index has fallen about 3.5% year to date. During periods of rising rates, it is important to remain diversified in the types of bonds that you own because they react differently. Maintaining shorter maturity bonds and also adding international bonds that are in countries with different interest rate environments is especially important. If rising interest rates and inflation are being driven by higher economic growth, this can actually be good for stocks. As the economy grows, corporate profits should also be rising, which benefits stock prices. Many companies are also able to pass through the higher cost of goods to their consumers, so the profits have a better chance of keeping up with inflation. A trend that has continued since the fourth quarter is that value stocks are outperforming growth stocks. As we explained last year, the growth side of the market, which includes many technology companies, was up nearly 45% in 2020. And we believe it appears overpriced. For our outlook in 2021, we have been more optimistic about the value side of the stock market, which includes many financial-related companies, because their prices have not yet fully recovered from the pandemic. So far, this prediction has been correct, with financial stocks up nearly 10% and technology stocks about flat for the year, looking at companies in those sectors that make up the S&P 500 index. Overall, we continue to be optimistic about the stock market this year as the economy continues to recover from the pandemic. Economists are forecasting that GDP growth could be about 6.5% this year, according to the Federal Reserve. That would be the fastest annual GDP growth since the economy expanded 7.2% in 1984. According to the Centers for Disease Control and Prevention, the increase in vaccine distribution could mean that the U.S. reaches herd immunity by the end of the second quarter. As a result, we think the industries that have suffered the most from the pandemic, such as travel and entertainment, will see a big rebound in the second half of the year. We anticipate that investors change their focus from interest rates and inflation to the growth of the economy, and that the stock market, at least parts of it, will continue to benefit. Thank you for joining us for this quarter's market review and outlook. To our existing clients, thank you for your continued trust and confidence in us. If you are not a client, we would welcome the opportunity to review your investment portfolio and discuss your particular situation. Take care, and we'll see you next quarter.